Dear members, ladies and gentlemen, good morning here in China and good evening in the United States. I'm privileged today to host a session with two friends of mine, Tom Orlik, who is based in DC, and Zhu Ning, who is a co-Beijinger, in order to discuss a new book that comes out. As you know, the Chamber is celebrating 20 years anniversary this October, and we decided in the month of July, vacation time, that we are presenting books. So today is session number 5, and it's a new book that came out just about, I think, in June, and Thomas is going to discuss this with Ning. Now, Tom is an old China hand. He lived here for 13 years. He was with the Wall Street Journal, and now he's with Bloomberg, based in DC. And Ning is pretty much known to you from many events the Chamber had. He's Chair Professor of Finance, Deputy Dean of the National Institute of Financial Research, Tsinghua University here in Beijing. So the book is going to be interesting, and let me just start by saying that possibly we have a bubbly discussion, because not only Tom has written a book about it, also Zhu Ning brought a book out, and tellingly it says China's guaranteed bubble. So we have two bubbly books today on the agenda, and bubbles we will discuss, and I guess Tom will tell us that actually it's pretty severe, but don't worry. And let me just start with my favorite economist, the late Rudi Dornbusch, who said that when you predict the Chinese economy, or basically any economy, just putting it into China, crises take longer to arrive than you possibly can imagine, but when they do come, they happen faster than you can possibly imagine. So on this positive outlook, Ning, challenge Tom.
All right. Well, morning, everyone, or maybe good evening, everyone. Jörg, thank you very much for giving me this opportunity, and Tom, it's a great book that you have written. So let me just jump in and start the conversation with a few comments on bubbles. I mean, after all, I studied a bubble along with Professor Bob Shiller, the Nobel Prize a few years back, who is like the acclaimed bubble expert in the world. And he has correctly forecast the bubble of the internet bubble and the global financial crisis during the past 2 decades. So what can I share with some of my observations? There are 3 things I would like probably to start out with. The first is I would like to chat with Tom about what we define as a bubble. I mean, bubble is becoming more and more of a common phrase when people think of certain economies, when people thought of the internet companies in the late 1990s, think of the US and the global housing market in the late 2000s. So what is a bubble? And when we say there is a bubble in China, do we really think of something that's similar to what has happened to the US or to Japan in the past decades, or are we talking about something that's very different? After all, I mean, in the same Nobel Prize ceremony, Professor Jim Fama, a renowned economist from the University of Chicago, said he never believed there is such a thing as bubble, and he never will, in the way of he thought, well, bubble is just a temporary thing and it will correct itself. Whereas I think from a behavioral finance or behavioral economic perspective, where I'm coming from, we tend to think a bubble is more of a common phenomena. And when we talk about bubble, we are already saying this is something that would be ex post proven to be excessively overpriced. So this is the question I'd like to chat with Tom about, whether China is a bubble, and if it is a bubble, do we point our fingers into particular direction about where the bubble is? So this is the first set of questions. The second is, well, I think when talking about a bubble in China, as I did in my book, I think most people have in their mind about the housing market. The housing prices in China is really high. I mean, it used to be high in relative terms, relative to the rental income, relative to the household income. But then it is now high in absolute terms. I think that the prices in Beijing property market or Shanghai is now higher than that of Paris or Berlin for sure, and somewhere next to that of the broader area of New York City and London. It's still trailing Hong Kong, but Hong Kong is such a special place, and then we're still going to see where the direction of the market is headed. So when we talk about a bubble in China, are we talking about the housing market in particular, or as I mentioned in my book, it's probably a broader concept than that? I'll give you one example. Recently, there's a company, a Semiconductor Manufacturing Incorporation, which was recently listed in China's A-share, the Star Board. And after its listing, its share price is 3 times as high as of the same company's shares listed in the Hong Kong exchange. And that is after the Hong Kong share price has already jumped 100% within the matter of a month. So that is to say, the share prices in A-shares market is 6 times as high as it would otherwise be in the Hong Kong market. And this is not an isolated experience. This is actually fairly common among those dual listed shares of the very same company in China. So when we talk about a bubble, what bubbles are we talking about? If there is any particular direction, which bubble are more susceptible to collapse, if you will, or more likely to self-adjust eventually? So I think that's the second question I'd like to
let him start.
Okay,
Yeah.
so I'll stop here.
Well, thanks very much, Jörg, and thanks very much, Ning. It's a great honor to have this opportunity to share some of the main conclusions with my book, China the Bubble That Never Pops, with the European Chamber. I remember when, years back, when I first started reporting for the Wall Street Journal in China, the European Chamber, I think, co-sponsored a piece of research on overcapacity in China's industry, which was a real kind of benchmark, really put some data and some analysis around an important concept, which everyone was grappling with, but no one really had their hands around. And of course, the European Chamber's annual survey of its members is also a key benchmark for understanding the way foreign businesses view the China environment. So I've always, taken a lot of value myself from this organization and Jörg's leadership of it. And it's a great pleasure to have a chance to give something back. Ning, of course, had a number of the same words as me in the title of his book. We both have China, we both have bubble, we've got the same color as well. So I wonder if there's a little bit of friendly competition there for the sort of the crown of China bubble analysis. But I've always had a huge amount of respect for the insights which Ning brings from the world of finance to understanding these questions, and I'm very much looking forward to the conversation. So I was in China for 11 years, and through that whole time, there was this kind of thread of pessimism, this kind of thread of doom running through the Western commentary on China. Yes, the consensus wisdom said 10% growth looks very impressive, but if you poke beneath the surface, it's all financed by debt. And all of the debt is going to zombie firms or real estate developers building houses in the desert, or local governments building roads to nowhere. And so it's a bubble, and the bubble has to burst. And that's the sort of the story which we've heard persistently for the last decade. But of course, the bubble never bursts. Yes, there are little crises. There's the Wenzhou shadow banking crisis. There's the Liaoning meltdown and the sort of the slowdown in the northeast of the country. There's a trust product which blows up, or a real estate developer that goes bankrupt, or even Baoshan Bank going bankrupt last year. But on a national level, growth continues, wealth rises, influence increases. And so my motivation when I put pen to paper for my book was to try and understand why. So to come to Ning's question, which I think is just a very sort of sharp way to start the discussion, what is a bubble? Well, I think a bubble to me is a market where prices are being driven not by an understanding of fundamental value, but by an assumption that another buyer will come along and buy at a higher price, right? And that's what we saw in the internet bubble in the US in the late 1990s, for example. That's what we saw in some parts of China's real estate market. In Shenzhen, for example, we've seen increases in real estate prices, which seem to bear no reality to what's happening to incomes or rental income or expectations of demand in those markets. Why do those bubbles pop? Well, those bubbles pop because the supply of finance dries up, right? And so one fundamental point that I make in my book is that because China has a very high savings rate and because it's difficult to move funds offshore, the funding for China's economy, China's financial system, China's markets, broadly understood, just never dries up. And that's why China can sustain very high loan levels, probably a very large number of bad loans, but not have anything which looks like a systemic financial crisis. The second point I would make is that when prices move out of line with value, there's two things that can happen, right? Prices can collapse or value can increase, right? If you're in a developed country like the United States or Japan in 1989, for example, the growth isn't there. So it's hard for the value of the real economy, the value of assets to catch up with the prices that are being put on them. In China, because we're still in a period of relatively rapid growth, that relationship between prices and values can also move in a positive direction. And when I think about very high house prices in Beijing and Shanghai, for example, it looks like a bubble. But a different way of thinking about it is that the smart investors in Beijing and Shanghai have seen the future, right? They've seen what China looks like in 10 or 20 years' time when urbanization has continued and the smartest, richest people in a country of 1.3 billion people have moved to Beijing and Shanghai. And that's why prices are where they are, sorry.
Sean was that? No, he did cover this.
Yeah. Oh, great. Tom, I really appreciate your diving into the main, the meaty part of your book, and I'll probably follow up with two questions. Or maybe one comment, two questions. One is I totally agree with you. I don't personally think there are bubbles in China's first-tier cities housing market. Actually, one of my students, a PhD student at Tsinghua, did her dissertation on a very interesting topic. So instead of comparing housing prices across the country, she compared the so-called bubbliness of the housing market in different cities. And her conclusion is actually it's in the less developed areas of China, the so-called third and fourth tier cities, where the bubble were actually even worse in the way of how much the housing prices are relative to their fundamental value. So in that regard, I totally agree with you. And my personal take on that is, in China, the housing prices are a reflection of the provision of public services, and there's no comparison of how well endowed Beijing, Shanghai, and probably Guangzhou are with the hospital, the university, the high schools in the country. So in that regard, I totally agree with you on that. And going back to China's high savings rate, and also China's government's ability to mobilize resources, I think it is unparalleled in any part of the world, which I totally agree with. And I guess I probably want to tinkle that a little bit with the causality problem. That is because we have high savings rates so that we can spend, or it's part of precautionary savings because people are concerned there's a lack of safety net, so they would have to save in case their kids need to go to college in the US, in case they are going to be going to experience another situation like the pandemic. So I think is to what extent is the high savings rate really mobilized and usable for further consumptions, which will be the main, if not the dominant driving forces of China's economy going forward? So that's one question. The second, also related to your key point about China's ability to control the capital within the country. I think this is really what sets China apart from any other major economies. I mean, even for Japan, it has opened its capital flow pretty much in the late 1970s. So it has like a decade of free capital flow, free quote unquote, which means the resources and the capital can be allocated pretty much efficiently across the border. But China does not have that. So in the short term, I totally support your view that, well, that's actually ensure the stability of the financial system, that it's ensure the high savings rate and the high returns of capital. But what if going forward, at certain point, we would have to face the inevitable that China would have to integrate into the rest of the world, and then what would happen to capital flow, to asset prices, and to exchange rate of RMB?
So those are really big important questions. And so let me have a go at both of them. So the savings rate, I think, is incredibly interesting because it is both the kind of the original sin or the sort of the fundamental problem in China's unbalanced growth model, but also the reason why China can sustain that unbalanced growth model, right? So because China has such a high savings rate, and because that saving needs to be transformed into spending in order to sustain high demand and high employment and growth, so there needs to be enormous bank lending and enormous investment. That's how the savings which are put in bank deposits get transformed into investment which drives growth, right? And because that happens in a sort of very determined, but in some respects rather kind of clumsy and maladroit way, you have very substantial misallocation of capital. You have the zombie enterprises, you have the ghost towns of unsold property, you have the six-lane highway that I recall once wandering down in Yunnan province, which was unoccupied apart from by me and some rather confused looking cows. But because you have that very high savings rate, the banks have very strong funding, and banks which have very high strong funding can deal with a lot of bad loans. And we see that right now in the COVID shock, right? So in the COVID shock, China's banks, under instruction from the PBOC and the CIBRC, have said, okay, companies, we know you're in a difficult situation. You don't have to repay us this quarter, or even this half, or even this year. You can pay back your loans next year. And the reason they can do that is because they have a strong funding base, which is because China has a high savings rate. So the high savings rate is the driver of imbalances, but it's also the kind of the savior of the banking system. The second point I would make on this is it's changing, right? You guys are on the streets of Beijing. I've not been there for a while. I was back in summer 2019 and look forward to coming back again as soon as this COVID shock is over. But when you're on the streets of Beijing, you can see that the culture of the young professionals in Beijing and the culture of young people around the country is not the same as the saving, frugal culture of their parents and their grandparents, right? These are not people who are putting a lot of their income in saving accounts. This is young people who like spending, they like buying beautiful clothes, they like going out with their friends. So the kind of the high saving rate, which is so fundamental to our understanding of China, I think just because of a kind of a cultural and demographic shift is going to change. And then to your second question on cross-border capital flows, I think this is another really crucial question. And I remember being in Beijing in winter 2015, just after the PBOC had done that mini devaluation of the yuan, which triggered that panicked reaction in the market. And I remember going to my bank, and I won't embarrass them by telling the audience which bank it is. and trying to transfer some of my yuan income into dollars. And boy, was that a difficult conversation. I think I was sitting at that bank for about 8 hours, showing them different bits of paper. They really didn't want to change that money from yuan into dollars for me. And I think that was a fairly common experience at the end of 2015, because that was a moment where China faced a genuine problem with capital flight. There was a lot of money leaving the country quite quickly because people were really worried for a moment about a competitive yuan devaluation. And the reason why the PBOC moved quietly but effectively behind the scenes to make it harder to move money out of the country is that is something which could actually chip away at the foundation of stability in the banking system. Because if you have a lot of money leaving quickly, like a lot of money, not like $1 billion, but like $100 billion month after month, then the funding for the banks gets eroded, and that's when you start getting worried about some kind of financial crisis.
This capital outflow, I remember very well because members had problems of getting dividend payments out to service the headquarter loans. I went to see the chairman Pan from the State Administration for Foreign Exchange. And I said, why do you do this? I said, well, just my countrymen have bought into 150 soccer clubs. I have to stop that. And so I had great sympathy for Mr. Pan. On the saving rate, to the two of you, who is saving? Because Tom, you definitely nailed it. The younger generation is spending not only happily their money, but also their parents' money. And there seems to be a real shift. When you look at the high saving rate, is it the households? Is it the state-owned enterprises? Is it the government? Who is saving?
So I think it's a complicated and shifting story. I think in the period after WTO entry, when you had significant yuan undervaluation, that was driving very high corporate profitability, and there was a lot of corporate saving going on. Over time, I think that has changed, and the majority of saving, I think, is now being done by the household sector. A question here, an important question, is how should we think about the household sector? So I sort of presented a view on it, which was based on a generational model, right? You've got the old people who grew up in the sort of security of the relative security of a kind of all-encompassing welfare state, the famous iron rice bowl of the state sector, and then had that taken away. So they save because they've had their welfare state taken away, so they have a precautionary motive. But another important way of looking at it is through the lens of inequality. And there's been some very important work done by Gan Li of the China Household Finance Survey, Zhongguo Jiating Jinrong Diaocha, I think it's called. And what he shows is that saving is very substantially being driven by rich people in China. Your migrant worker just doesn't have enough income to save, even if they wanted to. But your real estate developer or your successful entrepreneur is making a lot of money and driving a lot of the savings.
Tom, I would probably like to follow up with a couple of observations in response to your question. One, I think I agree with your assessment in a way that I think at first it was household savings, and then I think it gradually transitioned into the savings made by the corporate sector. But then I think over the past few years, I think it is transitioning again a little bit away from the corporate. I think equally going, I wouldn't say equally, but largely going into both the section of the state and the household. And I agree with your observation that it's the rich or maybe the super rich that is contributing to a big part of the savings. That being said, I would also want to highlight at the same time that we're still maintaining a high level of debt, a high level of savings, the debt is creeping up pretty rapidly. I mean, especially for the household sector. And then I think also consistent with your observation, I think for one household sector level of debt to GDP ratio increased from about 40% in 2016 before you left the country to nowadays, I think somewhere around 50 to 55% of the GDP, which is, I mean, still in line with major economies in the rest of the world. But this rise of 15 percentage points over 3-4 years is really alarming. And that's also exposing the fact that whereas the super rich are wealthy and saving, the people who really need the money are not having the money. Not only do they not have the money, they have to turn to alternative ways of financing to get it. And to that end, I have a very telling example. A very good friend of mine who's a helper, her son had bought the newest model of iPhone, which costs about 10,000 RMB. And this is the first time that this friend's helper knows that they even have a credit card. So his son or their son puts a 10,000 RMB charge to the credit card, which they don't even know how to repay. And then quickly, within a matter of 3 or 4 months, that 10,000 RMB grew into 15,000 RMB. So this is just like one very small anecdote of how the younger generation is consuming, but they're consuming based on not savings, but on depleting, maybe even overcharging their line of credit.
Yeah, that's really interesting, and it reminds me a little bit of a trip I took to Wenzhou a couple of years ago, and of course, as I'm sure you all know, back in the 80s and 90s and 2000s, the Wenzhou shadow banking story was a really positive story, right? It was a story about entrepreneurs finding unusual, unconventional sources of finance to pay for their assault on global markets, right? Wenzhou's rise, Wenzhou's kind of success as the global factory for buttons and zips and lighters and locks and pens and all the little things that end up in a drawer and you don't know what to do with, that was financed by shadow banking. But when I was in Wenzhou a few years ago, what I found was, well, there is still that going on, but actually there's something else as well. And a lot of the shadow bankers have turned their attention to financing consumption. And they're paying for people to send their children overseas to study, for example, or put a down payment down on a new home.
Plastic surgery.
Plastic surgery, yeah. And that's fundamentally different, right? One thing that sort of is important to think about in China compared to the US, for example, is, well, the US has borrowed a lot of money and used it to build McMansions, right? Houses that they couldn't afford and which didn't generate a return. And that's a sort of fundamental reason why we had the great financial crisis. China borrowed a lot of money and some of it was misallocated, but a lot of it went into productive uses, right? Infrastructure, industrial, building industrial capacity. And when you're directing your credit, when you're directing your lending at productive uses, you've got a shot at generating enough returns to pay it back. If credit starts going much more towards consumption, if it's the new model of iPhone, if it's plastic surgery, well, where's the return on that? And so the shift in credit towards funding more consumption, I think it's the beginning. We're at the beginning of that process, not the end. I don't think household borrowing at 55% of GDP is like a particularly worrying level, but the trajectory certainly is something we should be keeping an eye on.
Tom, let me first address the members. You can ask questions. Rachel is going to be the one collecting the questions. She's our chief censor based in Pennsylvania. And she's then going to throw it at Tom or at Ning. Tom, just to your book, you mentioned 4 growth cycles. And having been here since '82, I feel like I'm part of that history. And you said the first cycle was Deng Xiaoping's decision to open the marketplace. And then the second cycle started with his Southern tour in 1992. And the third was Prime Minister Zhu Rongji's state sector reform and WTO accession. The fourth growth cycle was the massive stimulus after the global financial crisis in 2008. So what is the fifth cycle going to look like post-COVID and in the frame of possibly decoupling? What's your fifth growth cycle going to be looking like?
Jorg, I know you're a modest man, so I didn't want to put this in the book. But as we're just with friends now, I want to make clear that you were quietly involved in all of those growth cycles, and they wouldn't have been the same without your guiding hand behind the scenes.
Of course.
And you're going to be there for the fifth cycle as well, so that's one of the reasons I've got some confidence. So the first thing to say is the fifth cycle is not going to be as exciting as the previous cycles, right? We are not going back to the period after Zhu Rongji cleaned up the state-owned enterprises and put China into the WTO, and we had the demographic boom coming in, and we had years of growth of 10%, right? That's not going to happen. Some fundamental things have changed. Debt is high, as we see from behavior from the US and some alarming speeches from Secretary of State Pompeo and others. The global attitude to China is changing and becoming more hostile. So the capacity for learning from foreign technology and selling into foreign markets is going to be growing at a slower pace than it has in the past. China's demographic cycle has turned. We now have a shrinking working age population. I looked at the data the other day, and I think China will lose a share of its workforce equivalent to the entire population of France over the next decade. Now, Jorg is from Germany and I'm from the UK, so I think we can both agree that if the entire population of France just disappeared, that would be, have some positives as well as some negatives. But when we think about the Chinese workforce, of course, we don't want to see 50 million workers disappearing. And I also want to make clear to any French listeners that was a joke, and I would be deeply regretful if that happened. But even with all those negatives, there are still some significant positives in place. So the first one, which is obvious, but I think it's worth saying. So in 1989, when Japan entered its lost decade, Japan's GDP per capita was 85% of the level in the US. So Japan was already a developed country. China's GDP per capita is 30% of the level in the US. So there is a lot of space to grow just by catching up. The second thing I would say is people look to the government for reforms, right? And they look to the government for market reforms. And Xi Jinping's government has done a lot of things, but I don't think they've really delivered on that promise of market reforms that we saw at the third plenum back in 2013. But what people forget is that drivers of growth in China don't just come from Beijing. They don't just come from Beijing reforms, right? Often they come from the bottom up. The household responsibility system, which drove agricultural growth in the 1980s, that was a bottom-up initiative. The growth for the export sector in the 2000s, that was small private firms operating in Guangdong and Zhejiang and Shandong. And if we look at the next 10 years and we think about what's happening with e-commerce in China and how that's connecting more entrepreneurs to the mainstream of national opportunity and giving them access to markets and access to data to inform their decisions, I think potentially that is another bottom-up growth driver that could be quite important in the next decade.
Well, Tom, I would have loved to have a French posting the next question. Maybe they're sharpening the tools. But I would like to open it up, and of course everyone knows that you are kidding and joking there. But I think that we have questions coming in, but let's start with our very own Rachel. She has a question for Ning and yourself.
Thanks, Jorg. Tom, if you were writing this book now, with the COVID situation, seeing how the Chinese economy has responded and also how the world economy has responded, how would that change your assessment?
That's a great question, I actually think I've actually given it some thought, and I think actually, so the first thing to say is that COVID is a human tragedy, tragedy for the people of Wuhan and China, tragedy for the people here in the United States and everyone else who's affected. COVID is also an economic and financial stress test, right? When the COVID shock hits, you can tell how resilient your economy and your financial system and your system of governance is. So let's think about what happened to China in the first quarter of the year as COVID hit. So state-owned enterprises saw their profits collapse. Real estate developers saw home sales collapse, and so their profits collapsed as well. Local governments saw their tax revenue collapse and their land revenue, their land sales revenue collapse as well. And who are the biggest borrowers in China's economy? Well, it's the state-owned enterprises, the real estate developers, and the local governments. So if there was going to be a financial crisis in China, if the bubble was going to pop, then surely it would have popped in the first half of 2020 when all the biggest borrowers ran out of money and so were unable to service their loans. But of course, the bubble didn't pop. We didn't have a financial crisis. China fell, but didn't fall as far as most other major economies, and now it's recovering more quickly than most other major economies. So why is that? Well, I think it goes to some of those obvious but unrecognized sources of strength and resilience that we see in the Chinese system. In particular, the high savings rate and the ample funding for the banking system. When a banking system is very well funded, it doesn't actually matter on a short-term time horizon if loans get repaid or not, because the banking system can stay resilient and stay operational.
I'd like to follow up with a couple of comments. One is, going back to my book, I think I agree with Thomas' assessment. I think the biggest resilience or the biggest strength of China's growth model is the power of the government, the powers of the government's ability to mobilize resources. And that has been reflected very well in how China has managed through the COVID-19 situation. That being said, I very much like Tom's analogy of the stress test. And I think it is a stress test, not just on the private sector, but also on the public sector. And to that front, I would like to bring up to your attention about China's fiscal situation. I think China's fiscal situation was very sound back in 2008 when China went through the global financial crisis. And that's partly responsible for China, how China has successfully come out of the crisis without too much damage. I think that being said, over the past decades, through the large infrastructure investment, through the large support of the SOEs, through the further advancement of the SOEs, and going through this COVID-19 situation, I think you're seeing that the strength of the fiscal might of the central and in particular the local governments are being put to test. A very telling example is the local government financing vehicle of Qinghai province. This is a provincial level local government financing vehicle which went into default a couple of months ago. And this is the first time when a provincial or state level financing platform defaulted. So this tells you how tight the cash flow has become over China's economy. And this is not, I think, an isolated incident. This is not a static situation. So I think that is something I think we are watching very closely. I think China is handling the COVID-19 situation very well, showing the rest of the world how strong its system is. But I'm also a little bit concerned about this very success is inviting some animosity. I think this is actually aggravating the tension which China is having with the US and some of the Western countries. And that's also something I think we have to watch very closely.
I think so Ning's too polite to say it in a straightforward way, but I think underlying that statement is basically the view that the publication of my book, China, the Bubble That Never Pops, has actually caused the bubble to pop, falsifying my evidence and my conclusions. So that just underlines the importance of all listeners to this call and indeed all European Chamber members buying the book as quickly as possible before this information gets out and my sales collapse.
Right, but only after all the French members left the chamber. Rachel, next question.
This question is from Ignacio Rodriguez at MAPFRE. What is your opinion on the future exchange rate direction of the renminbi in terms of appreciation, depreciation, or current stability?
Well, I mean, that's a great question. I normally answer questions like that by saying, if I actually knew which direction major asset markets were going to move in, then I would have placed very large bets on that, made a huge amount of money and retired to a yacht on the Aegean Sea. Clearly that hasn't happened, so you probably shouldn't take my view on future exchange rate movements very seriously. But what I will say is that something sort of fairly fundamental has happened in China's management of the exchange rate, right? Back in 2005, we had a yuan which was undervalued and managed by the government. And over the last 15 years, through a process of kind of careful incremental reform, not always perfectly managed, we talked about that misstep back in 2015, but in general going in the right direction, China now has a exchange rate which is market set and a yuan which is close to fair value. And so what that means is that the yuan has gone from a one-way bet on appreciation to a two-way bet where it's difficult to say which way it's going to go. I would also add that I think this speaks to one of the sort of important themes of my book, which is the economic policy competence of China's policymakers. If you go back to 2005, the big ask from the US, the big ask from the world was liberalize your exchange rate, bring the yuan to fair value, have it moved by market forces. That's going to be good for you, it's going to be good for the world. And China, in a sort of cautious, incremental way, has delivered substantially on that objective.
I'd like to just say a couple of things. Well, I'm not going to say anything that is not consistent with the PBOC official stance because I'm sitting on the Monetary Advisory Committee. But I would like to say two things. One is, I think I totally agree with Tom. I think even if someone could foresee the long-term trend of RMB, which I think probably Tom and I both have a view of our own, it is a very tricky thing to do hedging or speculation with the short-term fluctuation, which has increased quite a lot over the past 3 years. The second is, I think whenever we talk about RMB exchange rates, I think we always talk about it in relative sense to US dollars. And then I think it is as important a question to ask the exchange rate of RMB as it is to ask the long-term trend of US dollars.
Rachel?
So the next question is from Frank Schmiedel at the EU delegation. Who is going to pay back China's accumulated debt, which is close to 3% of GDP? Isn't there a risk that debt service puts a brake on economic growth? Could it even lead to a period of stagnation like in the 90s in Japan? Tom, I think you're muted.
Sorry, I muted myself. So that's a great question, it's sort of really fundamental to my book. So the big answer that I provide in my book, it goes something like this. So firstly, yes, there has been enormous misallocation of capital in China, and yes, there are a lot of hidden bad loans on the balance sheet of China's banks, especially city-level banks. We were speaking with a senior banker recently, and he said there are lots of Baoshangs, right? There are lots of those little city banks that potentially face a problem with solvency. But because the funding base of China's banking system is very stable, there is no trigger for a crisis. The money isn't going to run out. The banks aren't going to be forced to recognize all of their non-performing loans in a sudden moment. And because China is at a relatively low level in its development process, because GDP per capita is still just at 35% of the level in the United States, there is continued space to grow. And even though a lot of loans have been allocated poorly, a lot have been allocated to productive purposes. So the answer to the question, who is going to repay that 250, maybe even 300% of debt which China has taken on, is, well, China itself is going to repay it.
Yes, I think I was very much worried about this problem when I wrote my book to start out with, but then I think over the past 3-4 years, I'm less concerned. Not that the debt is coming down any bit, it is still increasing, but then let's not forget we're entering in the ultra low interest rate era, which we have not seen before in history. So even though the debt is still there, the burden of repaying that is actually somewhat diminishing, partly thankful to the COVID-19 situation, actually.
Rachel?
The next question is from Daniel Rose at BDE. People have the feeling that
Rachel, we lose you.
Chinese house prices are.
Oh, say it again, say it again.
Is it okay now?
Yes, better.
This is from Daniel Rose at VDE. People have the feeling that the China house prices are already too high for a long time. Will they go down after the bubble pops?
So that's, I mean, the real estate sector, as Ning noted at the beginning, so there is a long history of real estate bubbles triggering financial crises, right? So Japan in 1989, some Asian countries in 1997, the US in 2006, 2007, they all had a problem where real estate was overpriced, the market corrected, and there was a crisis. And so people look at China and they see, oh my goodness, it costs more to buy a house in Beijing than it does to buy a house in New York or London. That can't be right. There must be a bubble in China's real estate, and when it bursts, that's going to be a huge problem for China. And that is a plausible story, and I do not rule out that eventually happening. But I think there's some powerful arguments in the other direction. So the first argument in the other direction is, yes, China's house prices have gone up very quickly, but China's incomes have been rising very quickly as well, and China has been involved in a multi-decade urbanization boom. So demand for housing has risen very quickly as well. The second point I would make, and I think this is something which is probably not obvious to people who don't spend much time in China, is that the government has a lot of policy levers that it can use to address the problems in the real estate sector. So maybe I'll just share a story from a trip I made to Guiyang, the capital of Guizhou province. So I traveled down to Guiyang actually to do some research on the supply side reform agenda, but I ended up finding out a lot about the real estate market. So Guiyang had a big problem with overcapacity in real estate. They had a lot of empty tower blocks. And if the market had been allowed to correct, then the real estate developers would have been forced to lower prices on those empty apartments to sell them, and there would have been a risk of a collapse in the local real estate market. But the market was not allowed to correct. The local government borrowed money from state banks and used that money to pay residents in local low-rise buildings to move out of their homes and move into the apartment complexes. And then the local government got out their bulldozers and they knocked over all of the old low-rise buildings. And they said to the real estate developers who had just sold their apartment blocks, would you like to buy some more land? And the real estate developers said, yes, we'll buy the land from you. So the local government sold them the land and repaid the state banks. And that is a sort of a remarkable story. And it's a story which isn't unique to Guiyang. It's a story which was repeated in cities across China. and impacted millions and millions of households. The slum clearance program resulted in millions of people losing their old home and getting some compensation to move into a new home. And when you have a government that can do that, and I'm not making a judgment about whether it's like morally good or bad, I'm sure there's enormous human cost in that process, but when you have a government that can do that and move millions of people and billions of yuan to solve the problem of overcapacity, then the problem of bubbles in the real estate sector or ghost towns in the real estate sector starts to look a bit less serious.
I would like to share some of my thoughts, because I think a real estate bubble is like one of the centerpiece whenever anyone talks about bubbles in China. So first I want to start out by saying, well, I don't disagree from Tommy in a way of how people are growing in their income, therefore they want to afford or move into a better apartment. That being said, I would like to highlight the essence of a bubble. The essence of a bubble is expectations. So I, for one, tend to be a little bit more pessimistic in the way of once the expectation of housing prices will keep rising, once that expectation is gone, I'm very concerned that people will have no interest or very little interest in buying any additional apartment. And this is on top of the fact of a quickly aging population. The pace by which China's population is aging is faster than that of Japan, than that of South Korea, and then that of Taiwan. And we have all seen what's happening with the silver age population in Japan in a way of, I think according to OECD, the total population in China is going to shrink from 1.3 billion to 700 million. And that's 80 years away. And 80 years is a long period of time, but then it's not that insurmountable. So in 80 years, China's population will be about 1/2 the size of its current population. So I guess the eventual question is then who is going to fill up those apartments that we have sold? Because even according to the survey by PBOC a few months ago, even for the moment in China, every household has at least one apartment, if not more. And we have all seen in those corruption cases that a corrupted official could have more than 100 apartments. So by the end of this century, we're going to have at least on average one household, 2 apartments. And my guess is by that time, the average size of the family will shrink below 2 or around 2. So I'm still doing that mental exercise in my mind about what's the end game. And the end game is we are having a big glut of oversupply in the housing sector. But true, it is still very difficult to buy an apartment in Beijing, Shanghai, and Shenzhen. But then I think it's never the housing market in New York or San Francisco or Chicago that's causing the global financial crisis in 2008. It is southern Florida, some part of Arizona, certain part of California. It is where those new development areas which is tipping the leverage. And the final comment, I tend to agree with Tom in a way that even if we're going to have a bubble in the housing market, I don't see a pop, so to speak. So in that sense, I totally support Tom's story or the title of the book. I think if anything, there will be a gradual moderation, so more like Japan, unlike the US. For one, as Tom pointed out, a large part of the assets are being held by the banks, and the banks are state-owned, so they're not going to flood the market. Two, we are not a fully market economy, so the housing prices is, after all, within the control of the government. It will be a very long and gradual adjustment.
Given what Ning just said, I think that's another good argument to open the borders and let more foreigners come into the country to fill up empty apartments.
Very much welcome. I think we have to.
Yes. All right, Rachel, what's next?
Maybe the people of France could move there.
Yeah, they fill up part of Chaoyang. Yeah.
The next question is from Janet Zhang at Keck. How much impact do you think decoupling is having on China's economy?
So I wonder if this is my old friend Janet Zhang from Dragonomics. If it
Yes.
is, then hey Janet, good to hear from you. So I actually think this is rather consequential. I'm sure many of you have have read the speeches, recent speeches by Secretary of State Pompeo, Attorney General William Barr, and National Security Advisor Robert O'Brien. And they paint an extremely bleak picture of US-China relations. Even when we were having the trade war in 2018 and 2019, and relations were clearly extremely challenging, the underlying objective was still to deal with some problems like market access and intellectual property so that the trade relationship could continue on a more even basis, right? So the objective, even though US and China were fighting, the objective was to strengthen the relationship. And when you read the speeches by Pompeo and Barr and O'Brien, that the tone has completely changed. And the tone is one of existential struggle between two fundamentally opposed systems. That's the tone which is kind of coming through. And if that is the new policy of the US, and of course there's a big question mark there because Pompeo is an important person, but he's not the president, and we have a presidential election in November, and it's not clear who's going to win it. But if that is the new strategy or the new approach of the US administration, then I think something important has changed for China. Because China has risen because of its own intelligence and because its population has worked very hard, but also because it has benefited from a favorable global environment, right? The US opened the door to the global system. And if that attitude is now changing, and especially if the US shows greater capacity to work with allies, then the concern would be that China faces more difficulty accessing global markets, more difficulty in tapping global expertise and global technology. And if that happens, then I think that's going to be bad news for global growth, but also a new challenge for China's leaders as well.
Rachel?
Thanks, Tom. The next question is from Charlie Wong at ValueCap Research. How do you see the progression of stock and bond market financing in the bubble framework? Does this contribute to more disciplined investment or further contribute to asset speculation?
That's a great question. I note that Jorg and Ning maintained a dignified silence in response to the previous question about decoupling, which makes me think that I've just grabbed all of the third rails and kind of wave them around above my head. So let's talk about different sources of financing. So China, and I'd be really interested to hear Ning's view on this because he's someone who lives and breathes China's financial system. So China is a bank-dominated system, right? And bank-dominated systems have some problems attached to them. Specifically, they have a problem with transparency. The bank understands the quality of its loans, but that is not visible to anyone outside the bank, right? An investor in a Chinese city bank just has to trust that that bank is accurately reporting on the quality of its loans. And so that lack of transparency is a big problem in China's financial system. But banking also has an advantage because a bank hasn't, whilst no one outside the bank has a good view on the quality of the loans, the bank itself has an intimate understanding of the quality of the loans. And if you're in a developing country where you probably can't trust corporates to produce very accurate accounts, then maybe having the greater transparency, but also the greater distance that comes from equity and bond investing doesn't actually work. Because you have the illusion of transparency, but actually equity and bond investors don't have the resources or the understanding to really understand the quality of the assets which they're investing in. So a lot of people are critical of China's bank-dominated system. It clearly has some costs attached to it. I think because the bank has that intimate understanding of the quality of their borrowers and can monitor them on a very close basis, there are also some advantages there as well.
Uh, Tom, I would like to add a few things to what you have said, which I fully agree with. I think whether a financial system is dominated by banks is not necessarily a telling indicator about how efficient it is. I mean, Germany is actually also running a main bank financial system, which has turned out to be quite efficient and well-functioning. The problem, I guess, with China's financing system is, I think, lies in twofold, and one is motivating my book, is the government guarantees. So given that the bank is state-owned, everyone believes everything is safe. So I think for all those wealth management products, for those trust products, I think investors used to use the word from the question, speculate. I have bought lots of trust products and wealth management products without bothering to check what those products are, because I know they're coming from banks, so they got to be safe. But then with the new rules on asset management products, the so-called 资管新规, and with increasing defaults from peer-to-peer lending and from trust products, and this year in wealth management products sold by banks, I think that belief that religion has gone away. So I think this is one, going back to the question, we have to rely more on equity financing and bond financing. And I think to that, I think that the CSRC and the NDRC are doing a lot trying to encourage and foster the market to grow. I think the challenge there is Chinese investors are so used to risk-free investment that they are so used to the idea of I invest, which means I make money, period. There's no risk factor being involved. And now they were being forced, or they were being induced to have to judge the risk aspect of each and every investment for themselves. So I think that's a learning process. And I had an interesting discussion with a very senior official in the CSRC last week. So we were both agreeing on if we were to start the capital market in China all over again, we know what to do. But given where we are now, it is hard to jump from where we are now to where we want to be, because the investors have been so used to not having to make their own decisions. Instead, they listen to what the government has to say. So I think that is one big gap we will have to overcome or overjump before we can have a well-functioning Western-style financial market. Not is to say there's no default, there's no defects in the system, but then if that is where we're headed, to the question, I think we still need some long-term of investor education and investor investment literacy education to go along with.
Well, Tom, the European Chamber will start working on a report, as you have been so kindly praising our past reports, and it's about decoupling, and not what it does to economies, but frankly what it does to companies. So the financial aspect, the technical part, the trade tariffs, and we hope to launch it when Biden gets inaugurated in January. So let's see. Rachel, next one.
Thanks for painting a rosy picture of the election, Jorg.
Hope dies last, huh?
Fingers. We have another question from Daniel. What do you think about about China's private manufacturers' profit rate? It looks quite low now, and it seems hard for them to continue.
That's a great question. So China's small manufacturing firms have kind of faced a perfect and persistent storm, right? So you have the yuan, which has appreciated, I don't know, 40% over the course of the last 15 years. You have wages, which go up 10% a year. You have land prices, which continue to rise. And then you have Donald Trump saying we're going to impose tariffs on all of your sales to the United States. And then you have the COVID shock, right? Which forces them probably to close their operations for a period of time. So it is not an easy environment for small private firms. Whilst the COVID shock will pass, a lot of those other structural stresses, more expensive exchange rate, more expensive workers, more expensive factors of production are not going to go away. Now, that's a kind of depressing story, and it's a story we hear a lot. I'm not convinced that it's a story which is going to be especially negative for China's future. And here, I think we are kind of the victim of the data system that we have inherited from China's industrial past, right? So I spent 11 years as a China economist looking at industrial output, fixed asset investment data, right? And these are data series which are very well suited to telling us about an industrial economy where capital spending is the most important driver of growth. But something important has happened in China. The services sector is now bigger than the industrial sector. We do not have good data on the services part of the economy. So a lot of stories which we tell about problems in China are actually stories about a part of the economy which is getting smaller as time passes, and we do not have good data to tell us about the more exciting part of the economy, the kind of Alibaba, Tencent part of the economy, which is growing much more quickly, or the small private firms that presumably are doing a bit better by focusing their energies in that area.
To circle back on the idea of a bubble, I think there was a recent article by the Wall Street Journal. I think part of the story mentioned something which was raising some eyebrows in China in a way that the banks have made some favorable loans to small and medium enterprises in Shenzhen. But what happens to the enterprises which receive those loans is they receive the loan, they close down their shops, and then they use the loan to buy another apartment in Shenzhen. So I think this is sort of about the manufacturing. One thing is they're facing struggles and they probably have to do a different model to continue in their business. Another is, well, if there is an easy and highly lucrative alternative on the side, which is the housing market, that's also siphoning a lot of the entrepreneurial spirits and efforts from the manufacturing sector.
I haven't heard specifically about this yet, but I wonder if there are also small businesses in Shenzhen that are taking loans and then using them to buy copies of my book, China, the Bubble That Never Pops, which has got a lot of extremely important information which they could probably use to start a new business.
Rachel?
Thanks, York. I do have a question of my own. I'm curious how you assess China's Belt and Road Initiative in terms of these state-owned firms and a lot of state-backed capital being pushed abroad, and that's often criticized as just taking over capacity and pushing it out of the borders. So what do you see the development of those projects now, especially in light of COVID and also in light of geopolitical tensions?
That's a great question, and there are people who sort of devote their entire sort of their professional lives to thinking about the Belt and Road. I think especially of I'm probably going to get the name wrong, but Nadej Roland, who does fantastic work on the subject. My view is if you look project by project, there are a lot of problems, right? If you look at the Sri Lankan port, if you look at the Pakistan debt, if you look at the Kenyan railway, it's not easy to find examples of projects where there's been overreach, right? Too much money has been borrowed by governments which ultimately are not able to repay it. At the same time, at its heart, I think the Belt and Road Initiative has a value proposition that makes sense. Very large parts of the world, Africa, big parts of Southeast Asia, big parts of Central Asia, have a huge infrastructure gap, and they do not have the funding to fill it, and they do not have the expertise to fill it. And China has ambitions to do more on the global stage, and they have funding and they have expertise of building infrastructure. So there's something sort of fundamental about the Belt and Road kind of package that has the potential to deliver significant value for China and significant value for recipient countries. Working out those details at the country level preventing overreach by sort of greedy local governments or ambitious Chinese companies is proving hard to do in a number of cases.
I thought that I had a cool question for the ending of this session, but Janet just beats me on this one. Rachel, maybe you can read Janet's question on the inner and outer.
Yes, from Jiang Chong. Yeah, Janet. What is your interpretation of President Xi recently calling for inner cycle focus and outer cycle and its impact?
Maybe Ning goes first.
Oh, okay, Tom. Well, I will probably take the first step this time, given how much closer I am to the speech. Well, I think there are probably two things. I mean, just like many other speech that the president have made previously, I think he emphasized on the importance of international collaboration to start out with. That being said, I think given the changing international dynamics and also given the developing dynamic, the developing pandemics, I think, I mean, there is a shift in sort of the urgency or the priority of certain investment and certain economic policy. So I think, I mean, it is something that we have to pay close attention to in the near future.
So I think Ning is going to be closer to this one than me, but I'll take a stab at it. So I think it's not just China, right? The whole world is now reconsidering global relationships, right? Everyone has been worried that as the COVID crisis hit, they couldn't get enough enough personal protective equipment for their hospitals and essential workers. They potentially couldn't get enough pharmaceuticals for their sick people. And so I think there's a kind of a global reconsideration of the way supply chains work and what we can rely on to get from overseas and what we need to build at home. And the question is, how far does that go, right? How far is the reconsideration of global supply chains? And if it's fairly far reaching, what is the impact on countries like China, which have grown for a number of reasons, but one reason is because they have successfully positioned themselves at the center of global diversified supply chains.
Fellows, I have to close the session. There's a great question out there by Janet. How real is the 3.2% Q2 data set? And this gets me to a product placement. Tom has written a wonderful book years ago, which is still on my desk every day, and it's called Understanding China's Economic Indicators. So I can only recommend this book in order to figure out what's real and what's fake in the China data set. Having said that, I would really like to thank the two of you for spending the time and the effort, and very good luck to your book, Tom. The Kindle, of course, is available around the world. The hard copy might take a while for some people. Definitely, Ning has beaten you on the product placement. This book came up more often. I saw you were trying to catch up, but too late, my friend. Ning takes the cake. Let me just finish by saying that we have a great session tomorrow at 4 o'clock Beijing time. We have the new book out by Mareike Olberg and Clive Hamilton. It's called Hidden Hand, and it's about the world can respond to China's authoritarian advance. That's going to be controversial, of course. And I was very privileged to have as a moderator the former Vice Chancellor of Germany and Foreign Minister Joschka Fischer, who's going to take on this book and do this at 4 o'clock tomorrow Beijing time. So tune in. Thank you very much. It was great fun, and see you, or at least hear you tomorrow at 4. Take care. Bye.
Thanks, Jörg. Thanks, Ning. Thanks, Rachel. All the best.